2025 has been an interesting time in the stock market. We've seen record movements. We haven't seen the S&P drop this quickly very many times in history. We haven't seen the S&P recover this quickly very many times in history. We certainly have not seen the VIX do what it's done. We haven't seen fear spike like this and recover like this. There's a lot of important lessons to learn in investing, and there's one very specific lesson that we need to get used to if we're ever going to do anything good in the stock market, and that is cycles. Now remember, the stock market is very much like life. Any lessons we can learn in the stock market, most of the time they can be applied to our personal lives. So think of this as kind of a double-edged situation here. We're going to learn a little bit about investing, and hopefully this will teach us a little bit about ourselves as well. Let's dive right into it here. I want to talk about the book Mastering the Market Cycle, written by Howard Marks. He's the founder of a massive fund, Oaktree Capital. It's huge. He's been super successful, and he's written quite extensively about the markets, stock markets, the economy, and so on. And I can't say enough about how much people should read this, but specifically Mastering the Market Cycle is a book that I think everybody needs to become familiar with. And honestly, whether you're a stock market person or not, certainly if you're in anything investment related, if you're in real estate, stocks, any kind of that stuff, this book is like the Bible. But it's a good book to read to understand human psychology. It's really more of a psychology book than anything. Marx talks about this time is different, right? And what do we mean by that? We mean that this time is different when every single time when there's market panic, when the stock market sells off and everybody thinks that it will never recover again. Nobody wants to buy a discount in the stock market. They all want to buy when everyone else is buying, not when everyone else is scared, because you think if the stock market can go down 10%, it can go down 20%. If it can go down 20%, it can go down 100% and ultimately go to zero. Right? And so this time is different really applies kind of on both sides of this move here. When we see that the stock market sells off and there's a lot of panic, we don't want to think this time is different because human nature is panicky. When we see somebody doing something, we do that thing very oftentimes. This goes way back. Our DNA, it's hard-coded in our DNA, and this goes way back to if you see somebody running, you're assuming they're running from like a saber-toothed tiger, and you better run too so you don't get eaten, right? It's hard-coded in our DNA. So when we see that everybody is selling and we have a chart in front of us that verifies that, we want to sell, we want to get out, we want to do all this stuff. It's fine to get out. What we want to do is make sure we get back in, right? Make sure that we take opportunities to buy at discounts. Could you imagine if a pair of shoes was $100 and it was on sale for $50 and you said, I'm not buying those shoes because they'll be worth $10 tomorrow. Well, who cares? You got something at a great value, right? And that's the stock market. So we saw a 19% drop over the course of 48 calendar days, not trading days. It was more like 36 trading days or something. 19% drop from February 25th highs to April 8th lows. And then we saw a 20% rally from April 8th lows to May 19th highs. 41 calendar days. So when we think to ourselves, this time is different, what did you miss out on? You missed out on a 20% move in the stock market. That's huge. That is huge. That's basically like we got a year's worth of really good gains in the stock market in 41 days. That's a big deal. We don't want to miss out on that kind of stuff. So just remember to yourself, when you think this time is different, it almost never is. How many times have we said to ourselves, markets are cyclical because people are cyclical? And how many times have we said to ourselves, Joe will never change. He's been doing the same thing for 50 years and it's terrible and he'll never change. Joe is cyclical. Humans are cyclical. Humans cause markets to be cyclical. It's as hard for markets to change as it is for humans to change because we repeat over and over again these behaviors. So the stock market, even though everybody thinks it's going to go to zero, usually doesn't. And even though everybody thinks it's going to go to 1 million, it also doesn't, right? When the stock market sold off with all this tariff news lately in this first part of 2025, it was coming off all-time highs, the highest point that the stock market has been ever, right? You can see this right here. This is about a 13, 14-year snapshot of the stock market. But coming off all-time highs. What happens at all-time highs? people are looking for reasons to get out, right? We're at all-time highs. When do we take profit? When do we take profit? Not to say that the tariff news was not shocking, but to have that happen at all-time highs, these things tend to happen. When we get at all-time lows and we get to all-time highs, news tends to be a catalyst for change. As we're at all-time highs in the S&P, tariff news hits, the market sells off a bunch, right? We'll see this repeated over and over again in the course of the stock market. As our good buddy Mark Twain said, history doesn't repeat itself, but it does rhyme, right? And what does that mean? It means not the exact same thing happens every single time, but the same version of these things happen over and over and over again. And an important point of that is trees don't grow to the sky, right? A tree does not grow to be 10,000 feet tall. Trees can only grow as high as they can grow. And likewise, markets don't tend to go to zero. So when everybody was crazy about Bitcoin in 2021, when everybody was crazy about NFTs in 2021, that was an extreme. That was a market cycle and an extreme. And we saw that crashing down pretty hard. Not to say that won't come back in the future. It very well could, but that was one of many, many examples of cycles, right? Where we see that things don't go up forever, but likewise, they don't go down forever. What's an example of that? Here's the dot-com crash of 2000. This is the peak right here in 2000, goes down and kind of bottoms out 2002, 2003. That's a long time, right? That was 2 to 3 years of the market selling off and people not knowing, will this stop? Will this go down forever? Now, one thing that's important to note right here is this is pre-government intervention. The Fed was not intervening. They were not saying, hey, we'll step in and we'll pump a little bit of money into the market to ease people's woes. They were not doing that. And even without doing that, we saw what probably turned out to be a longer sell-off than needed to be. If the Fed would have been involved, it probably would have been a shorter sell-off. But the market didn't go to zero. What happened? It recovered for several years. And then what did we get again? We got to the 2008 crisis where everybody could get a loan. Every person working at a restaurant serving tables owned 2 houses, right? They didn't need to prove any kind of income. They just said, hey, I make X amount of money and that's enough to buy 2 houses. And the bank said, great, we think that's great. That's fantastic. So what happened when all of that came undone? Once again, the market crashed. It crashed hard. Again, at the bottom of this was when the Fed got involved and said, obviously people are dumb and they're doing dumb things. We need to save humans from themselves. And so we saw the Fed get involved, and what happened? The market goes up again. And we can go, if you want to look at a chart of the S&P going back to 1900, go ahead, give it a look, because what you'll see is that it never disappears. It never goes to zero. We have hard crashes. We have the Great Depression. We have .com. We have 2008, 2020, all these times. It never goes to zero. Never goes to zero. Some could argue, hey, the the turkey doesn't think that anything is wrong until Thanksgiving Day. Well, Thanksgiving Day has been coming for, I don't know, over 100 years now. The stock market is a big machine, and one person or one event or one thing is not going to ruin that and take it to zero, right? That's super important. This is the point that Marx makes in his book. Markets don't go up forever, but they also don't go down forever. And we need to remember that. What happens at these cycle extremes, right? Let's talk about at highs first of all. Conveniently, assets should be untethered from the constraints of valuation norms, is what Marx argues, often starting with the explanation of this time is different. Why should something be worth 10 times what it normally is worth? Well, this time it's different, and this thing will be worth an endless amount of money forever and ever, right? That's the euphoria at highs. And then we have at lows. Asset prices collapse due to an assumption that none of the things that supported the value in the past can be trusted to work in the future. We just saw that. 1.5 months from the stock market low. And at the low, everybody said, all these things aren't going to work. The global economy is done, and none of this stuff will work again. And we're likely to see a much larger recession than anybody could ever imagine. We either think at highs, everything is totally worth the value that it is overvalued at. And at lows, we think all the reasons that held the stock market and the economy in place no longer matter. We can't trust them. They don't work anymore. This is a very common psychological reaction in the stock market. How many times do we think that in life? Who's having a bad day and thinks, this may not get better, ever? Have you ever been sick and you thought to yourself, I can't remember what it feels like to be healthy? It's human nature. It's what we do. Let's talk about why cycles exist. Human involvement. It's all people. We bring emotion to our economic and investing decisions, causing euphoria at highs and despondency at lows. At lows, we're like, that's it. It's over with. Not going to work. At highs, we have all the confidence in the world that everything will get better. What can we do about all this? How can we make sense of all this? In Mark's book, he argues that while it's literally impossible to forecast the future with any amount of certainty, but recognizing where we are in the various cycles, whether it's economic, profit, credit cycles, the psychological cycles, this is what gives us an edge, right? A significant investment advantage is knowing where we are. We can't predict the future, and a lot of things in the past don't matter today. Where we are is what matters. And this goes back to just simple life. You can't do anything about the future. You can't do anything about the past. All you can do is know where you are right here, right now, today, and go from there. And it's no different for the stock market. So if you're asking yourself, how do I stop missing these crazy dips and opportunities to buy dips? We're never going to find tops and bottoms perfectly, so go ahead and take that out of your mind. What you can do is look at where things are. When the S&P was at highs, we were getting pretty overvalued on a lot of things. It was getting expensive. So that's something we can recognize and say, maybe it's time to trim our positions a little bit. When everything gets low and we see that companies that make a lot of money are trading at really low valuations, maybe it's a good time to buy because they'll come back, right? So these are things we want to keep in mind. I hope that is helpful. I'll continue to kind of just give some of my favorite things from investors and the knowledge that they have learned and shared. As a hedge fund manager myself, these are all valuable lessons for me, but I hope they're valuable for you guys when you look at markets and look at opportunities and look at these things and think to yourself, how do I stop missing these? How do I make the most of these? How do I improve? I can't recommend more. Read Mastering the Market Cycles. Follow me on LinkedIn and X, and we'll stay in touch. Thanks a bunch, everybody.